Hey guys, this is a futures trading tutorial. I'm going to go step by step through a sample trade and the strategy that traders would use to actually identify areas to get in and out at, how to identify the trend, the actual price that you want to get in at, which way you're going, either long or short, the potential profit and the potential risk as well. So I'll leave all of those different sections as timestamps in the description. You can check that out. Firstly, we have to come to a futures trading screen though. So I'm going to use Bybit right here. I'll leave a link to them in the description. They give a deposit bonus. So if you're a new client and you make a crypto or fiat deposit, they'll give you up to $4,000 as a deposit bonus in your futures trading account. So I'll leave that link if you want to check that out. The first thing I want to do though is look at funding rate. So when you open futures positions, you're going to have to look at this funding rate because this is something that you'll be paying most of the time. You do sometimes receive this if you are going into a trade that is opposite of what the market is doing, but I just assume that we're going to have to pay this when our position is open. So this is going to come off of the P&L. It's not a big amount, but it's something to be aware of. You can see the funding rate right here is 0.0041 and it's exchanged every 8 hours. You can see that. So what I have to do is take 0.0041 and then times that by 3. That's going to give me a day rate. So to open a position here, we're going to be paying 0.0123 as a rate that's going to come off of my P&L. Now if you want to make that a yearly amount, that's 4.48%. So not a huge amount to have these trades open, but the longer you have it open, the more is going to come out of your P&L. So something to be aware of. The other thing is, what do we actually want to use to fund our positions? So when you trade, you can obviously add your assets right here. And if you don't know about futures, what essentially you do is add collateral just above my head right here and then fund the position. Now you can fund that in two ways, either through dollars, essentially like a crypto stable coin, or through a crypto coin itself, like Bitcoin. So you can choose that. We can come up to the left-hand side and I'm gonna choose USDT perpetual. This may also be called USDM perpetual, just means US dollar margin. So you're using a stable coin to margin and collateralize your positions. Most people use this because having a dollar amount in there is not going to fluctuate in price in terms of your collateral amount. Whereas some people do use inverse perpetual. This is where you actually put a crypto coin on there. Like if you're trading Bitcoin, US dollar, you'd put Bitcoin on there or Ethereum. The problem here is that it's way more volatile because you have the crypto asset going up and down in value, and you're also trading it as well. So you can see there's a lot more potential volatility there, which is why most people actually just put USDT on the account to actually fund the positions. The next thing you have to keep in mind when trading futures is how much leverage that you want to use. You don't have to use leverage when trading futures, but many traders do. I really suggest beginners not use any leverage whatsoever. It's very dangerous if you're using leverage, especially without knowing too much about risk management. But traders use leverage here, so you can see long 2x and short 2x. So you can change the amount of leverage that's used dependent on if you're going long or short. I'd suggest keeping them the same, but you can very easily change the leverage here, leverage long, leverage short. You can change that to how much. Now with crypto is so volatile anyway. So, I wouldn't use too much leverage at all. I also would not use leverage to make my positions larger than the amount that I actually have to trade. Leverage, in my opinion, is used to give yourself options to enhance and grow trades over time as long as they become de-risked. And I'll just go through a quick example of this right now. Most people suggest that you only risk 1 to 3% of your trading portfolio at any given trade. So if you have a $10,000 portfolio, you're going to be risking $100 to $300. That's your max loss per trade. And the way we're going to go through how to work this out with a stop loss as well. So I'm going to show you exactly that. But most traders would suggest if you have a $10,000 portfolio, each specific trade has a max loss of 1 to 3%. Now, the reason leverage is used and people use leverage is, for example, putting less down initially so that they have more to scale into the trade if it starts to work out for them. So let's say you have a $5,000 portfolio and you want to risk 2%. So the max potential loss on this trade that you work out through your technical analysis is $100. Now, if you just use 2x leverage right here, you don't have to put $5,000 down. You can put $2,500 down and you have a position size that's 5,000. You're still only risking this much, 2%, based on your profit and loss. But what you're doing is using leverage to put less down initially. The reason why this is important is because if the trade goes in your favor, what you can do is actually scale up your trade. So you have options when you use leverage. That's how I would use leverage, to actually just put less down initially and then have more of my capital available to do other things, rather than just scaling up your trade initially, because all you do at that point is just increase your risk. And everything about futures, and especially day trading futures, is managing risk, not trying to leverage up your positions. Now we can get into the trading strategy. The first thing I would do is look for something called market structure. So what I'm attempting to do here is just find out which way the price is going to go, right? So that's the initial thing. Is the price going to go up or down? And what is the market structure? What is the market structure? You can see that by identifying an up or a downtrend, looking at some multi-time frames, and then looking at support and resistance. So for example, as of making this video, Bitcoin is undoubtedly in a bear market. So we're in a really terrible bear market, to be honest. And so, you have to initially say, if we're in a bear market, then what we're looking to do is on the probability of the trade, we want to go short or bet on the price going down. So what we're going to look at is some market structure to help identify and confirm that we should be doing that. We either confirm or deny that initial analysis. So yeah, it's on technicals, but it's also, I look a lot at the macro as well. So I think that macro and news and events and other markets definitely shape everything else as well. So not just technicals, but as of making this video, we're in a bear market. And so you're kind of leaning towards the bearish side, leaning towards selling rallies and going short at recoveries, hoping to see another leg down. That would be it for a short trade. So how do you identify a trend? Well, what I would do, if I'm trading on the 1 hour here, day trading, what I would do is look at other time scales. So I'm gonna go on the 4-hour chart. We'll just reset this and see if this is telling me else. It's also telling me that we're in a downtrend. Why? Because you can see the moving averages right here, all pointing down. The price is coming up to these price levels and getting rejected off. It looks like a downtrend from this chart as well, but just to make sure, we can go to the day chart and then we can see over a much longer period. This is now months and months, and we can see we are absolutely in a downtrend over many months. And so until the macro changes, you have to just go with the trend. So when we're in an uptrend, you just buy dips. And we're on a downtrend, you look to sell rallies until something changes and the bear market finishes. But that's for an entire new video. So, we're in a downtrend here. So that is what you would go through. And so we're going to go back to the 1 hour and try and, trade a shorter time frame. So we are bearish and we're looking to sell rallies. So that is where you want to go. So as we can see the price right now, we're not in a rally here. And so even though we're biased to go short, after a price dump like this from 20,000 to 19,200, probably not the best time to go short, right? You want to be going short on a rally. So as of right now, you're probably not going to trade here. You're probably going to say, you know what, I'm going to wait until the price consolidates or maybe has a few up days, comes back to resistance, and then we can maybe go short again, unless the whole market structure has changed at that point. Now, what you can see here is a previous trade that I did, and I actually recorded this video for the crypto course. And so everyone in that crypto course is going to be able to see the actual trade kind of go through a few days ago in real time. But this was the area where we could have actually shorted right here and expected a continuation to the downside. The next thing as part of market structure is to decide where support and resistance is, so you actually get a level that you want to go in at. Now, we're not going to look at chart patterns in this video. That's for other videos. I'll leave a lot more videos in the description. But back here, when I was placing this trade, what I was looking for is support and resistance. What do I mean by that? Areas where the chart finds a level and gets rejected away from. And you can see that resistance, now remember, we're trading to the downside and we're short here. So you can see that resistance here that is quite clear. Actually, happened a couple of times. So we actually sold through this. The market tried to recover and got rejected, tried to recover again and didn't even make it there. Then as we came on, we saw this clear price level where the price got rejected again at 21,673. Got sold off, tried to recover again, and then run out of steam a couple of times at this price level again. So this was the area where you actually, if you are going short, you want to get in where the price is trying to recover and getting rejected off. That's going to give you a probability of it getting rejected and essentially making a similar move to what we saw at this price here. So the price goes up to resistance and gets rejected off. And we were expecting that to potentially happen again. It wasn't exactly the same move, but it did reach the price level as we saw previously. What you also need to do though is find the opposite side, because you need to know when to exit as well. So you get your entry by support and resistance. When you're trading a short trade, you're looking at resistance to go in at, and then you're looking at support for a potential area to get out of your trade. Now, previously, what you can see is that this was an area of support where the price bounced off. And then if we go lower, we're kind of looking at this, what I call an area of value, which seems to have been resistance a couple of times, but the price broke through it and actually found support right here. So this is probably a key area of trade. Now, always look to what the actual price is around this level. And you can see that was around 19,500. So I guess we're looking at around 19,250 as an area of potential support right here. So we'll put that on the chart. But remember, we were trading a few days back. That's why I have this line here as well. So that is right there. Now, as part of the pattern as well, is that what I was actually seeing here was an ascending wedge, which is not really a bullish pattern. It's kind of a bearish pattern, especially in downtrends and bull markets, which we've identified already. So what you can do here is just essentially look at the level of where you would get in at. So where the pattern started. So I drew this right here because this is where the pattern started. You can see we came off that support level up into the pattern. And so I would draw that as the potential drawdown if the pattern would then actually break through that and come to the downside. And it did in the end. So that is where I would probably place the kind of exit or the price level of exiting if we were to go short here, looking for the price to come down to buy it back to make profit. Now you can use that as a level, or you can use this as a level, which is the previous price, or if you're looking to take the trade longer, you're looking at other important levels, and that means you'd be looking down at this level here. So there's 3 levels dependent on how aggressive you want to be and how long you want the trade open for. Now we need to make sure that this trade is going to be profitable and has a good risk reward ratio. If it doesn't, then we reject the trade. The way that I would do this is looking at the stop loss price first, because my position size and everything else comes from my max potential risk. So if I said that I wanted to go in at this price, which is 21,422, I need to look at my stop loss. Where do I place my stop loss? I'm going to place that essentially at a level where I feel the trade is going to get invalidated. If the price goes to that level, then the trade or the direction that I think the price would move in has not moved that way, and I need to get out of the trade because I've basically been wrong. Where do I place that? Again, I personally look at support and resistance levels. So we were at a resistance level here, but the price can always fake out and go a little bit above and then back down. I'm going to look back at the chart and see what level potentially would the price go to as well. So we're seeing a big downtrend here, and obviously after a very short, sharp downtrend, you always get this kind of recovery. So what I'm going to look for is essentially a level around here that would potentially be an area that it may go to. So what I would do is literally come back here and just say, around this level, I can see the price. Again, there's just like an area of value here that I can see. The next level would potentially be up here for resistance. Now, this second level is way too high for me. I think if the price reaches 22,000, then my entry here going short is 10% wrong, and that's just way too much. So I'm going to look at a level around here to place the stop loss. So I also want to give the trade a little bit of room as well. So if I'm going short here, I think around this level, 21,800, something like that, 22,000 is going to be around about the level where it really is a wrong trade. So I could place it here, or if I want to be take less risk, I can just put it down to around 22,000 or something like that. That seems like a decent price. Around 22k. It's a round number, and if it gets to there, potentially we're breaking out through that to the upside. So you can place your stop loss through that support and resistance. There are other ways you can do that as well. They're for other videos, linked in the description as well on YouTube. And then obviously we want to take the take profit, which I've said we're going to find levels here, which you can change. If you want to take a little bit of risk or you want to get out quicker, look for the first area of support and resistance. If you think this trend is going to really continue, you can obviously try and make this larger. But what we know now is how much risk, and that's really the important thing, is how much risk you're taking. So you can see that the risk is $657 away. So what I need to do now is go to a position size calculator and find out how big my position can be. So what we do is we come back and get the open price, which is this here, which is 21,422. So I'm going to put that in. And then I want the stop loss price. Now remember, because I'm going short, the stop loss price is above. You can see it's around about 22,000, right? So I'm just going to put that in. 22,000. My account balance, let's just say it's 10,000 right here. And like I said, you always want to take 1 to 3%, I would say, of your position, of your actual cash position as a risk. 2% is good for me right here. If you want to take less risk, 1%. If you want to take more risk, 3%. 2% is good though for me, so I'm just going to calculate the size. Now I know I can trade 0.346 units of Bitcoin, so my trade size is now known. Why? Because it's just worked out from your open, your max potential loss, which is the stop loss price. So your open, your max potential loss, your account size, and how much risk you're taking in that max loss scenario. That's going to tell you how big position size you can get in at. So 0.346. I'm going to go short here. So you just go over, you obviously put the price in, which would have been 21.422. And then you do the quantity and then you open your short position like that. Now I want to talk about managing your positions and also why I chose this risk reward ratio and actually thought it was a good trade. What you can see by using this indicator right here, it's a fantastic indicator. Go on the left-hand side, it's this one right here, and then you can choose either a long or a short position. So obviously we're in a short position. Now what you can see is it tells me straight away that my risk reward ratio is 2.18. If I want to trade a little bit shorter, like less time open for the position, you can bring it up a bit. That's going to make your risk reward worse. It's basically saying what's your max loss versus the expected gain. 1.85 is a decent amount. I would never ever go into a trade that was less than 1.25. And here's why. We can look at some stats and it essentially shows you what your win rate is needed to be versus, as a reflection of the risk reward you're putting in each trade. What we can see here is that if you have a risk reward multiple for all of your trades of 1.5, you only need to win them. You only need to be correct 40% of the time. If you have a risk reward multiple of 2, you only need to be right about that trade 33% of the time. If you're taking trades that don't have a potential, risk reward multiple very high, as you can see here, 0.5, you need to be correct 67% of the time just to make money and not lose. So that is why, most traders will always go with a R multiple 1.25 or 1.5, something that's, looking like the trade can work out in a better way, because if you're taking too much risk as opposed to your potential reward, then you have to have a much higher win rate. How would you actually manage an active trade though? In my opinion, there's 2 ways to do this. The first is to work out your win-loss ratio for that specific trade and then just leave it. Just leave the trade to run out. That's perfectly fine as a way to trade. Now what you can see is that what happened essentially was the trade, I'm just going to put that right here to what it would have been. The trade actually did come down. So the price came down and you can see it's a sell-off right here. So just market structure, we're making, I'm going to draw this, we're making basically lower highs. Okay, so you went into the trade around this level. We actually went into a loss, but then the trade started working. So we have a high and we have a low, and then obviously we're just in a downtrend here, kind of mini downtrend here. So that worked out, and you can see it actually hit the take profit right about this level. So that would have been a great trade. Now, at any point in between, when you opened or when the trade started working out, which was this level and this level, what do you do? Well, there's 2 options for me. The first one is you can just leave it. Just leave the trade and let it run out. The second one, which a lot of people do, is try to manage the trade. So there's 2 ways to do this. You can either add risk, right? Or you can make the position larger, or you can essentially try and add to the position at a worse price than you initially got in at. And that's a decision that anyone can make based on who they are as a trader. So we got into the position around this level at 21.422. Now, what you could do is say, when I enter a position, I only want to take 1% risk and my position size is 1.73. Then when the trade starts to move into your stop loss, you could say, I want to just increase my size and position a bit because I'm getting a better price. In a short trade, that means a higher price. The downside here is that if it's moving into your stop loss, your trade's kind of losing. And so adding more risk isn't always the best, but it depends who you are as a trader. So you can come back and say, I actually want to add to the risk and then increase my size. So it depends who you are as a trader, whether you want to do that. The other option is to, when the trade wins and comes near to your take profit, is to then analyze the trade afresh, because we're about 4 days after this now, and we're in a new environment. And so you can now look, if I take some of this drawing off, you can now look at the trade at this level and say, basically we can see it's quite a bearish chart and we're meeting a lot of resistance. Do you want to essentially leverage up your trade further and just make it bigger? Now your entry price is going to be worse because you initially got in at 21,244 and now you're getting in at 20. So for a short trade, that's worse in price. But you may think, you know what, this is a new trade and we're actually going lower, and it did go lower. So you would have done well here to essentially come over to your calculations, you know, and basically what we can do is move the stop loss down a little bit. So actually what you can do is say your entry comes lower, but you can also move the stop loss down. Now what that does is de-risks your initial position. So instead of that stop loss being 2% of your capital, if you move the stop loss down, suddenly that first trade now gets de-risked. And that means you can go into the new trade with more risk, right? So you can enter a fresh trade with 2% because the other trade is de-risked. And so that is how you can use leverage at times to actually go into more a winning trade. So you have cash on the sidelines because of the leverage, and you're going into a winning trade here without taking more risk because the trade is working for you. So there's a few different options you can do here depending on who you are as a trader and how much risk you want to take. But one of them is leave it. The other is kind of manage it and maybe add risk if the price moves against you, but that's kind of more dangerous. So you're actually adding more risk there, which is never really, you know, kind of what you want to do. Or you can wait for the trade to move in your favor. And if you're confident that the trade is still, you know, you're in a good trade and you read the market correctly, you can now add size to those positions whilst decreasing your stop loss to kind of add size, but de-risk your first position at the same time. So just to recap there, first thing is you need to identify the trend, whether you're in an uptrend or a downtrend. That can be through technical analysis like I showed you. I prefer to add fundamental analysis, news and macro events as well, because they affect the price way more in my opinion. Then next is to get support and resistance lines to actually give you prices that you might want to get in and out at and initiate trades at. You obviously need to look at your entry price and then a potential stop loss price to find out how much risk that you're actually going to take in the position and to get your risk reward ratio properly set. The next is account or trade management. Do you want to just leave the trade, or do you want to actively manage it and change around and reduce your risk a little bit or add to the position? And then obviously you need to look at potential exits, where the price may go that you actually want to exit and say the trade's over and that was a good trade. And then always keep in mind the funding rate, because that is going to take away from your profits. I'll leave the link to my crypto investor course in the description if you want to get a little bit more in depth and go further. We have trading groups and I'm in those as well, so you can ask me some questions. If you want to use Bybit or other trading platforms, I'll leave them in the description as well. They often give sign up and deposit bonuses. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.